to pick up the slack. But they're not. This is all a bunch of BS. There isn't all this demand for stable coins. That's just a bunch of hype so that the president's friends can make money selling all this crap and selling stock in companies that are creating all these stable coins that nobody really wants. I mean, why would you want to hold your dollars in a stable coin and earn no interest, right? At least if you hold your dollars in a money market, you earn the interest. If you sell the money market and buy a stable coin, now the stable coin issuer keeps your interest and you get nothing. But to the extent that stable coins buy treasuries, it's because mutual money market funds aren't buying them, because people are going to take their money out of a money market and use it to buy the stable coins. And by the way, Bitcoin was down 1.5% today. Bitcoin is now down, I think, about 16% from its all-time record high over a month ago. In nominal terms, or priced in gold, down 16%. I forget what it is in priced in dollars. The high was 125, and now it's about 115. But we're down 16% in gold. More.
Peter Schiff has consistently maintained that the current increase in gold and silver is not merely another instance of market enthusiasm, but rather a direct reflection of the fragility of the global financial system. He believes that the Federal Reserve's recent transition to a more relaxed monetary policy is a transparent acknowledgement that the system is incapable of withstanding higher rates without rupturing. This action, rather than fortifying the economy, reveals its vulnerabilities, rendering the dollar susceptible to a crisis of confidence in U.S. debt, as Schiff describes it. He emphasizes that the forthcoming surge of turmoil will not be limited to the housing or banking sectors, as it will affect the very core of sovereign credit and the dollar's status as the global reserve currency, in contrast to previous downturns. Schiff underscores that the most significant indicator of this transition is the decrease in foreign demand for U.S. treasuries. Countries that previously relied on American debt as a safe haven are progressively decreasing their exposure by allocating capital to gold as a more dependable store of value. This consistent transfer of reserves from Asia to Europe and beyond implies that the global public's confidence in Washington's fiscal discipline is eroding. The consistent accumulation of gold by central banks underscores that the shift is strategic, not speculative, for Schiff, and de-dollarization is not a theoretical concept but an unfolding reality. He cautions that the process will intensify as the dollar continues to deteriorate, thereby reinforcing gold's position at the heart of international finance. Schiff contends that silver's narrative is just commencing, despite the fact that gold has already claimed the limelight. Although the metal has broken through the $40 threshold, it is still significantly undervalued in comparison to gold, which provides ample opportunity for appreciation. In his opinion, silver will eventually follow the trajectory of gold with an even more explosive momentum, driven by its industrial demand and monetary role simultaneously. Schiff emphasizes that retail investors have not yet completely re-entered the market. However, silver has the potential to serve as the catalyst that propels the entire precious metals complex into uncharted territory once broader participation is restored. We are now presenting the excerpts from Peter Schiff's interview. Please subscribe to our channel and activate the chime icon to receive timely updates before we proceed with our discussion. I appreciate your assistance and hope you enjoy the video.
Gold is now up 40% this year alone in 2025. Silver is up 48%. These are incredible returns for precious metals, especially given that last year was also a very good year. But the only thing that's outperforming gold and silver are the gold and silver mining stocks. Today alone, both the GDX and the GDXJ jumped 5%. 5%. We didn't even have really a 1% gain in the price of gold, or almost, I guess it was about 1% because it was $40, so a little over 1%, but 5%. So we had 5 times the move in gold stocks today as we had in gold. And the GDX closed at an all-time record high, never been this high. And the GDXJ is the highest it's been in 13, 14 years, something like that. On the week, the GDX was up 3.75%. and the GDXJ was up 2.2. The star of the day was Barrick Gold, which was up 10% in one day. That's rare for a company that big to be up 10%. Normally, you might see some smaller companies, although all the gold mining companies are small when you compare them to like the tech companies. But in the mining universe, Barrick is, I think, the second biggest, following Newmont, which, was still up almost 5% on its own today. So not too shabby there. But these are all big moves. Year to date, the GDX is now up 113%, and the GDXJ is up 115%. Right? So these stocks are doing better than tech stocks. Newmont is the best performing stock in the S&P 500, but you would not know about that if you listen to the mainstream financial media. In fact, there was very little, if any, talk at all today in the mainstream financial media about gold stocks hitting, new all-time record highs. Nothing. They did focus on the S&P hitting a new record high. Sure, the S&P made a record high. Year to date, the S&P 500 is up 13.3%. 13.3%. Gold stocks are up 10 times as much. 10 times as much. So what's the big deal? And in fact, if the S&P is up 13%, but gold is up 40%, what does that tell you? That means in real terms, the S&P is down 27%. This is a major bear market in stocks if you price them in real money. But nobody's pricing them in real money. They're pricing them in funny money. And so you're getting an inaccurate perspective. Now, in other markets that were significant on the week, the dollar was actually only up slightly on the week. I think that's going to reverse, but it's still very weak, the dollar index. What was also up were bond yields. Again, I was forecasting that when the Fed started to cut again, long-term rates would rise, and that's what's happening. The yield on the 10-year finished the week at 4.13. On Tuesday, the day before the rate cut, it was 4.02. So the Fed cut by 25 basis points, and the long end has already gained about half of that. It'll probably gain the other half next week. The yield on the 30-year.
The Federal Reserve's most recent indication of additional rate reductions has sparked a new round of discussion in global markets. Despite the fact that policymakers characterize the cuts as essential support for an economy that is exhibiting signs of strain, investors are not viewing the move in the same way. The dollar's appeal is diminished, real returns on U.S. debt are eroded, and the flight of capital into hard assets is accelerated in an environment of reduced interest rates. Gold and silver, which are already demonstrating momentum, are now in a favorable position to capture the flows of investors who are seeking refuge from policy decisions that appear to be more politically motivated than economically sound. The gold advocate cautions that the crisis of confidence in the stewardship of U.S. monetary policy could be exacerbated by the continuation of easing. Foreign creditors, who have historically served as the foundation of Treasury financing, have already reduced their holdings, and the likelihood of additional divestment has been exacerbated by subsequent reductions. Simultaneously, domestic investors who are observing inflation surpassing wage growth are discovering fewer justifications for remaining in cash or bonds. This environment reinforces the argument for precious metals, as gold is progressing toward new milestones and silver is on the brink of a potential breakout as it tries to catch up. The trend may solidify into a structural shift if rate reductions persist while inflation remains unresolved, resulting in a resurgence of tangible assets and a decline in trust in fiat.
Follow their lead, because Morgan Stanley said that you need to do this as an inflation hedge. Right? It's clear that inflation is going to be much higher than 2%. It's been above 2% for the last 5 years. The Fed doesn't even forecast it to get down to 2% for another 2. That's 7. And of course, that forecast is all BS. And I went over that in my other podcast. So I don't want to kind of steal that thunder. You got to watch it because it's a startling observation that I made about a startling admission that nobody else is covering. But given that inflation has been so high for so long, and likely to go higher now in light of the Fed's decision to cut rates, Morgan Stanley is saying you need an inflation hedge. You need to hedge your bonds. You can't have 40% bonds. You can only have 20% bonds. Now, I don't want any percent of my money in bonds, and so I'm already in gold and gold and silver mining stocks. But most of Morgan Stanley's customers don't own any gold. And now they've been told for the first time to have 20% of their portfolio in gold. That's a lot of gold when you have zero. So Morgan Stanley clients and maybe other clients who are going to maybe get similar advice as the weeks and months go by, they have to sell all their bonds or half their bonds and buy a bunch of gold. So what does that mean? Well, first, for bonds, it means lower bond prices and higher interest rates, which also means higher mortgage rates, the opposite of what Trump is trying to achieve by pressuring the Fed to cut rates. So what does that mean? That means quantitative easing is coming next, right? Because that's the only way that they're going to get, at least in the short run, long-term rates to go down and mortgage rates to go down. But if they do that, they just create even more inflation and create additional incentives to sell bonds. And maybe it'll be a 60-10-30 portfolio, 10% bonds, 30% gold. And eventually, maybe it'll just be 60-40, 60 stocks, 40 gold with no gold. In fact, I was listening to an interview with Jeff Gunlock on CNBC, and he recommended that investors have 25% of their portfolio in gold, their whole portfolio, not just the 60-40, but 25% in gold. And the people were shocked, and they were asking other guests about it who were like, I don't have any gold, right? Well, they're late to the party. People are going to be buying a lot more gold. And so this is going to push the gold price way up, obviously, if all these people that don't own any gold are going to now be putting 20% of their portfolio in gold. But getting back to what this means for the U.S. Treasury, how is the U.S. government going to finance these deficits? Because foreign central banks are no longer buying treasuries. They're selling them. They're buying gold. The Social Security Trust Fund doesn't buy treasuries anymore. It has to sell them to cover its shortfall. And now individual investors aren't going to buy treasuries because if they have 40% and they have to go down to 20%, they're not buying anymore. They have to sell what they got. And the Federal Reserve is technically still selling treasuries because they're still doing quantitative tightening. They're doing it in a very small amount, but they're still doing it. So right now, the Fed isn't buying. So who's going to buy? Maybe they're going to pressure the banks to buy more treasuries. Well, then they're going to have to make fewer loans. It's going to crowd out the private sector. Now, maybe they're hoping that the stable coins are going to pick up the slack, but they're not. This is all a bunch of BS. There isn't all this demand for stable coins. That's just a bunch of hype so that the president's friends can make money selling all this crap and selling stock in companies that are creating all these stable coins that nobody really wants. I mean, why would you want to hold your dollars in a stable coin and earn no interest, right? At least if you hold your dollars in a money market, you earn the interest. If you sell the money market and buy a stable coin, now the stable coin issuer keeps your interest and you get nothing. But to the extent that stable coins buy treasuries, it's because mutual money market funds aren't buying them, because people are going to take their money out of a money market and use it to buy the stable coins. And by the way, Bitcoin was down 1.5% today. Bitcoin is now down, I think, about 16% from its all-time record high over a month ago. In nominal terms, or priced in gold, down 16%. I forget what it is in priced in dollars. The high was 125, and now it's about 115. But we're down 16% in gold. More significantly, Bitcoin is down 15% priced in gold from its high 4 years ago. How do the Bitcoin hodlers explain that? That Bitcoin is 15% lower than it was 4 years ago if you price it in real gold. So if Bitcoin is supposed to be, digital gold on steroids, gold 2.0, why is it underperforming gold by a pretty wide margin over a long period of time, despite unprecedented hype to get people into gold. And in fact, I think that what's going to be happening in the weeks ahead is it's not just going to be people rotating out of treasuries into gold, but they're going to be moving out of Bitcoin into gold. I think a lot of people who have ETFs, Bitcoin ETFs, they're going to be moving into gold ETFs, and they may even be moving into gold mining ETFs like the GDX and the GDXJ that are doing much, much better than Bitcoin, delivering much greater returns, and they pay dividends. And they have a lot more upside potential than Bitcoin with a lot less downside risk. And by the way, it is very significant that gold mining stocks are now leading gold. It's also significant that silver is leading gold. These were the ingredients that were missing from the gold bull market. Right? All we had was gold going up, but not confirmation from an outperformance in gold mining stocks and not outperformance from silver. And now those were two of the reasons that there was a lot of skepticism of the gold market rally. Well, it's not being confirmed by silver. It's not being confirmed by the mining stocks, so it's probably not real. Well, those arguments are gone. I think you're going to see some major Wall Street money, institutional money, investor money, finally moving into gold when it's almost 3,700. But they're just getting started. And even if you look at these gold stocks, yes, the GDX just made a new record high, but it's barely above its record high from 2011, even though gold is almost double the high from 2011. And for the GDXJ, it still needs to rise by over 50% just to equal its 2011 high. Forget about beating it, just to equal it. So a lot of money is going to be coming in. So again, just like I've been saying, every time I've done one of these Friday market wraps, do not wait for Monday to buy your gold. As soon as you finish watching this, it's only about 20 minutes, right? And in fact, as soon as you're done, and obviously, maybe I should have said this at the beginning so people could have paused it, gone and bought some gold and come back. I waited too long. But now that it's almost over, when you're done watching, after you've subscribed to the YouTube channel and given this video a thumbs up, liked it, and put a positive comment down below, right? After you've done all that stuff, which won't take long, go to SchiffGold and buy some gold and silver. Now, you don't have to wait. They're open 24/7. You can fill up your shopping cart. You can give us a call. Do not wait for Monday. There could be a big gap up on Monday morning. So just buy it while nobody is paying attention. And then after you finish buying your gold and silver, then immediately go and watch my full 1-hour podcast on my main Peter Schiff YouTube channel to hear everything I had to say about the Fed. Because then after you finish watching that, you're going to want to go back to the SchiffGold website and buy even more. But don't wait, right? Don't waste that hour. Make sure you at least get some now before buying more later. And again, if you're aggressive, go to Euro Pacific Asset Management, Europac.com, and learn about my mutual funds, and in particular, the gold fund EPGIX. As much as I love gold and I love silver, I still love these mining stocks. They're not dirt cheap like they were back in April when I told all my SchiffGold customers not to buy gold.
Lower interest rates generate a direct impetus for precious metal prices, which enables gold to continue its upward trajectory toward new highs. The opportunity cost to possessing gold decreases significantly as a result of the lack of incentive to hold government debt, which creates a favorable environment for sustained institutional inflows. This change not only reinforces gold's status as a safe haven, but it also establishes the groundwork for a long-term price trajectory that could surpass current records as monetary policy continues to undermine confidence in fiat assets. Silver, which has historically been more reactive than gold, may experience an even more significant impact on its price. Silver frequently accelerates after gold gains momentum as a result of its reduced market size and the supplementary demand from industrial sectors. It is probable that a surge in speculative and retail activity would result from the breach of long-standing resistance zones, which would elevate prices to levels that have not been observed in more than a decade. The potential for silver to considerably outperform gold becomes a defining feature of the next phase in the precious metals cycle in such an environment. Please share your opinions on Peter's analysis in the remarks section below. If you find this video to be informative, please consider supporting our channel and activating notifications to remain informed about our most recent content. I will see you in the video that follows.